Hello, and welcome to another edition of Beaver Finance. I'm your host, Robert T. Anderson. In today's series, we're here to talk to you about life insurance. Now, first we'll jump into the definition of life insurance. So, life insurance is an insurance that pays a tax-free cash death benefit to your family or other beneficiary after your death. This can give them replacement income, help them pay off debt, and pay for your funeral and other final costs. Now, with life insurance, it does pay a tax-free death benefit. The premiums paid for life insurance are with after-tax dollars. This ensures that the death benefit does remain tax-free. Now, you can name a beneficiary, of course. Now, this beneficiary needs to have an insurable interest. So, of course, a spouse has an insurable interest, especially if you have a shared debt, such as a mortgage. Because you may want to list your friend, for example, as a beneficiary. But if they don't have an insurable interest, the insurance company is going to question that beneficiary designation. So that's always a test. Does that person have an insurable interest? Now, the death benefit, as I mentioned, can replace one's income. So, rule of thumb, take your income, multiply that by 10, that gets a good replacement income number. And then add in your mortgage, funeral costs, perhaps kids' education if you've got children. Add all that number up, and that will be the death benefit that you'll need. Now, do consider if that income replacement timeline is longer than 10 years, just add on, say, 5 more years if 15 years would take your children to, an age of post-secondary education. So that's how we typically calculate death benefits. Now, we've talked about obviously naming your family as beneficiaries, and somebody having an insurable interest. We also work with a lot of business owners. And in business, if you have a business partner, upon a sudden death of one of the business owners, whether that's your partner or yourself, there's certainly, a value associated with that deceased partner's value in the company. And typically the surviving business owner would have to pay out that value from the survivor's estate. So if that person's spouse were to inherit their shares in the business, the surviving business owner would need to purchase those shares from his deceased partner's estate. So life insurance is the perfect mechanism to pay out that need so that the business owner has the cash available for that purchase. It definitely makes it easier on the surviving business owner. It also gives comfort to the business owner that's no longer there, that their family is going to be taken care of, because the alternative is the surviving business owner might not be able to get a loan at that time and afford to pay out the survivor's share of the company. As well, on that note, the business, just like the owners are key people and have insurable interests, you might have a key employee in the business that if something were to happen to that employee, there would be a big impact to the company. And if that is true and can be proven, you can set up a life insurance policy up on that individual. So for example, if that key person manages all the operations, and it's a highly technical position, or it's a an individual that manages a lot of the sales and holds key relationships, if you can quantify that to let's say replacing their salary to hire someone new for that position, or lost revenue, all those types of things. Key person insurance is also common. Solution for life insurance can solve that need as well. And there are other scenarios in business, but we'll cover those in future videos. And lastly, I'll briefly cover the two types of life insurance, but we'll also cover those in future videos. So make sure you do subscribe and like this video so you can be notified about those future videos, because we love for you to follow us along. So the first type, and it's probably the most common, is term life insurance. So term life insurance is it's great for temporary needs, such as, a mortgage. It's exactly as it sounds. It's insurance that pays a guaranteed death benefit and has a guaranteed premium for a set term. Upon that term, the policy does renew, and it does have an expiry date. Typically around this day and age, not until your 80s will you hit that expiry date, but a very common term is 10 or 20 years. There are other durations, but those are the two most common. And secondly is permanent life insurance. So I won't go into too much detail, but there is universal life insurance, which is a form of permanent life insurance. So it's a life insurance that has a guaranteed death benefit. It has a guaranteed minimum premium that's required. But then you can actually put in extra premiums. So those extra premiums up to a maximum, and of course there's a minimum to fund the actual cost of the insurance, can go into an account within the policy up to prescribed limits, and you can actually get the choice of what you invest in based on what that insurance company offers as far as investments. So typically, mutual funds, those types of investments. So it can be great, if you've ran out of, RSP room, TFSA room, and you want to fund investments in a tax sheltered way as far as growth. The universal life can be a great option. There are other nuances, so you want to look into it. We're going to cover that in future video. And then secondly, there's permanent participating life insurance, or PAR insurance, which is life insurance that also has a guaranteed death benefit. Guaranteed premium the premium can be guaranteed for, say, 20 years, or it could be guaranteed you pay for life. Now, obviously, the premium is going to be different one way or the other, whether that's stretched out over your life or if it's crunched into, say, 20 years. And with permanent participating life insurance, or PAR insurance, the life insurance company manages all the premiums, invests that money at scale, and manages paying out claims as well. And then each year, the policy owners participate in the profits of that fund. Now, the profits are typically distributed over a weighted average of up to 5 years. So it is very smoothed out in terms of returns. So when there are very good years, they bank surplus. And then when there are poor return years, obviously they're taking from surplus, and you'll receive the same dividend subject to any annual review of those dividend rates. And that'll be credited to your policy. And what's unique is once it's credited to your policy, that investment or cash value cannot go down. So there are some really great benefits with permanent participating life insurance, but then again, we'll talk about that more in a future video. So hopefully you learned a lot. Hopefully you're excited to learn more about life insurance. We really hope you can subscribe, hit like, comment below. We will be coming out, like I said, with future videos on term, life insurance, participating, and universal. So please stay tuned, please subscribe, and we hope you like this video. Thank you.